A huge problem with so many businesses is they get into a rut. Whatever has happened, whether it's someone that didn't pay them, whether we've still got COVID legacy, there's still huge issues in the economy with cash flow. But because there is so much talk around the only solution being insolvency, and people not wanting to go down that path, or I still think there's a lot of, if I don't have any more equity left in my home, I can't get any money. No one will lend to me. And so there is, if you actually eat the frog and look at the thing that you're ignoring, that there are solutions out there that are not traditional solutions, that can help these businesses get back on track and buy them that time. And it's knowing the right specialists. So a lot of the time, exactly as you mentioned with that business, so what will happen with them from an ATO point of view is they leave the wind-up list and they then go into what's called the main debt pool. So they can then go into a payment arrangement. They then become in a compliant position, and all recovery action from the ATO will stop now that they've got out of the wind-up list and in a payment arrangement. So yes, obviously they've got to pay you back, and they've got to work out what else is going on. But just that one thing that you were able to help them with has taken them out of the whole enforcement action stream within the ATO.
And I think you're right. We're all about, and I think we're similar in terms of tax assure and asset-based lending, where our focus is actually trying to save the customer, trying to help them live to fight another day and keep them going. And that injection of cash can be a real positive thing for businesses and resolve short-term issues. But if you don't fix the problems at the core, you end up in the same scenario. Another deal we did recently, and it actually did relate to an insolvency situation where a company were in a bit of trouble, tax debt and a whole bunch of other debt. And they had a viable business because they had ongoing contracts. And so they had a couple of choices, whether they liquidated the entire business, shut it down, or they went through a voluntary administration process. So they'd got some advice around a VA. But the first thing a liquidator does when a company considers the possibility of going into a liquidation or into a voluntary administration scenario is they need to be funded. So they need funds to be able to put into their trust account to be able to run a voluntary administration process. And this particular company, regardless of the fact that they had contracts in place, they just weren't in a position from a cash perspective to be able to actually make that contribution to run that process. Now, they had other assets. There was this one happened to be a McClaren and a Porsche, funnily enough, two fancy cars sitting in a garage somewhere, which was released about 150 to 200K, which then went to the liquidator that funded that process. Now, that lasted for 3 or 4 months. The offer was made to creditors. There was a resolution where they only paid certain amount of dollars per dollar in terms of paying the creditors. That business is now still ongoing and viable. They did restructure their debt because obviously once you go through a voluntary administration process, you are a lending proposition again because you don't have those legacy issues hanging over the business. And if you were to lose a lot of that debt as a consequence of coming to an arrangement through a deed of company arrangement with your creditors, all of a sudden the business is in a lot better shape from a balance sheet perspective, and therefore a broker or another lender will come in and look at refinancing you. So in that particular case, we're going through it now where they are being restructured by a finance broker. That includes releasing some cash to be able to pay us back so they can get their assets back. So unfortunately, sometimes that is the best solution for businesses because carrying all of that debt and trying to trade your way out of that, it can sometimes be an impossible situation. So that's where asset-based lending can come in handy for a couple of different things, whether it's just dealing with cash flow issues on a day-to-day basis or avoiding a liquidation or being able to fund a voluntary administration. There is a solution, and as you said right from the start, this is a solutions-based business that can help out in the short term.
I think the message though, and in that whole story, you mentioned a whole heap of different service providers. So it's about the right service providers working together and getting the right help from the right people depending on where the business is at, what needs to happen. And I think previously when people have been running businesses 10, 15 years ago, you might have just had one general advisor. You might have had one stop shop. Often it might be your accountant who is your general advisor. You might have had a bank manager or a loan, better than me what they're called, when you used to walk into the bank and they'd look after all of the loans you need, and they were the only people you ever spoke to. So if those two people couldn't effectively help you, it was all over. But I think where the world is going now with specialisation, there's a number of people, but it's not the right fit for everyone. So like you said, it's a particular solution, the same as where we come in, it is a particular solution. For us is just the debt space, and it's finding those solutions and where they fit and who's going to help you best.